Welcome and thanks for joining us on Real Investment News. I'm your host, Scarlett Fakar. Today we are joined by a very, very special Christmas guest, the Grinch, who is going to be here to talk about one of Chief Financial Strategist Lance Roberts' most recent articles. He has something that just came out on why the markets have been rising since the election. And now there's two main narratives in Lance Roberts' article, Mr. Grinch, that support the narrative of why the markets are rising. Tax cuts, a lot of people, that's what people presume, and also earnings reports. But that's not truly the case.
Well, no, not at all. And of course, I am the mean one, so we can't just be all bullish now, can we? So the important thing here is that since 2014, profits are up about 3%, but yet the stock market's up more than 35%. So that's not supportive of the rise in the market. So something else must be, certainly, that has been pushing stocks higher. But so if it's not earnings...
Right. If it's not earnings, if it's not the tax cuts, then what is it?
Well, the tax cuts are simply haven't happened yet, right? So the expectations are that tax cuts may come, but the rally started really way back in 2009, to be exact. So the recent rally can't be part of the tax cut situation because that hasn't happened, and it wasn't part of the actual rally long before this. So the reality is that, when we look at tax cuts and earnings growth, that's not the real driver of what's happening, but it's been central bank interventions. It's been the $2 trillion that have been invested in the markets really since just the beginning of this year alone that have driven stock prices.
What can you explain in these graphs to us in layman's terms, what they're showing us, especially the asset price is not driven by profits after tax?
Well, that's exactly right. When we take a look at actual corporate profits again and asset prices after they actually pay taxes, asset prices are up over 35%, actually more than that even now since that article was written. But the expectation is that profits should be driving that. So those should be higher, but they're not. But when we take a look at the other areas of the market, we're finding out that this is really much more speculative in nature. It's been driven by central bank interventions, and that's what's pushing prices higher. Again, there's other graphs in that article that show that we have got one of the biggest extensions in terms of relative strength that we've seen at any point since 2005. So it ultimately means that there's going to be something I like very dearly, a big correction in the markets, which, that's going to really take a lot of Christmas away for people.
Exactly, and that leads me to one of the other things that he said in his article. The current market advance both looks and feels like the last leg of a market melt up as we previously witnessed at the end of 1999. So that's the correction that you're talking about.
Exactly. And wouldn't that just be lovely?
Would it? Would it be lovely?
Well, for a Grinch, it would be great.
For a Grinch, it would be good. Okay, so just how big of a correction are we talking about here?
Well, when you take a look at where we are currently in terms of the market extensions and just going a correction back to what would be calling critical support, important support, would entail almost a 30% decline. But there's a real possibility that because of margin debt combined with leverage in the markets, corporate leverage, and of course this push into, as investors have all jumped into ETF investing, this passive indexing meme, that when this begins to reverse, we could very well see a correction to the magnitude of up to 50%, which, again, wouldn't be anything out of the ordinary considering the last two corrections alone have been in excess of 50%.
One of the things that Lance also mentioned in his article were the 15 risk management rules. How does that play into this, too, as far as investors go?
Well, if I was him, I wouldn't have told people how to protect themselves because I certainly wouldn't want that for them. But, what those rules are is they're great investment rules. They're simple guidelines that investors should at least consider when managing money because, again, it's all about risk management. Ultimately, if we lose a lot of money and we give up all of our gains, then really what have we succeeded at in, investing over time? So, again, if you want to take all your Christmas presents away, just ride the markets. It'll be completely fine. But, applying a little bit of management, following those rules can certainly help you out as an investor.
If you want to go learn more, go to realinvestmentadvice.com. Lance has that article there, but you'll only find the interview with the Grinch here on Real Investment News, as well as our website, realinvestmentadvice.com. But the Grinch, Mr. Grinch, rather, not the Grinch. I really appreciate you taking your time out of your stealing holiday cheer from everybody to come on to our show.
Yeah, no problem. I'll be by your house later to steal your presents.